In this video, I'm going to dive into what's driving the market right now, and that's negative gamma exposure inside of the SPX. If you traded last week, you should have noticed the wild price swings, and the reason for that was the negative gamma exposure chart. It looked very similar last week as what it looks like for this upcoming week. Market makers currently are amplifying volatility, and there's a way to take advantage of it if you position yourself on the right side of the market. In this video, I'll show you how to capitalize on it so that even in times like last week, where 4 out of the past 5 days were choppy days, one was a trend day in which we went down minus 2.85%, and the other days we were up 2%, up 2%, down 2%, down 2%, and then up 2%, still be able to profit in an environment like this. To get started, we need to first understand what is negative gamma exposure, understand how we can use it in our favor to then build a strategy for it. Negative gamma exposure right now is around 3 key strikes, the 5700 strike, 5750, and 5800. What this tells us is as price approaches any one of these levels, we should very quickly see volatility start to kick into full gear. Now, one other piece of information that I think is worth comparing is the metrics from the last time we ran this exercise, which was Feb 21st, to this expiration series, which is March 11th, and compare the delta here, most specifically on the IV percentile. If we take a look at the increase in implied volatility, that's gone up nearly 8.5%. Historical volatility up nearly 2%, IV rank up nearly 37% and some change, and IV percentile is almost at 100%, up nearly 68%. That really helps to highlight the increase in volatility that we're currently experiencing and hopefully helps to drive home why these strategies, if employed correctly, can help you make a good amount of money. Now, a quick revisit to a table from the last time we discussed gamma. When we have negative gamma exposure, we're expecting our dealers, market makers rather, to sell the dip and buy the rip. That's to say we're expecting them to continue driving trend in the direction of the trend, and as a result, we expect to see greater price swings and increased volatility. Trend and momentum moves are oftentimes stronger. Sometimes you get the rug pulled very quickly from under you, and you'll notice a lot of fake outs, false breakouts, and stop hunting. Now, in this period, the strategy is to buy mispriced, inexpensive options if you're an options trader. Think out of the money options that are cheaper than usual against the direction of whatever the intraday trend might be doing. Also, momentum setups and also our favorite, the ORB setup, works exceptionally well here as a way to try and position yourself early on for a nice early entry into a strong trend day. Now, the key here is making sure you choose the right ORB setups, and I'll show you my trick to be able to do just that. Now, from a risk management perspective, in this high volatility period, it goes without saying that stop losses are crucial, and if you're bad about stop losses, this might be where automated trading becomes your friend. We already talked about being aware of false breakouts. Now, we need to combine all of this into some kind of an actual trading plan. For me, I've divided this up into 3 key time zones and changed my trading behavior based off of these 3 time periods. The first is the morning time period. The second is the hour right before the lunchtime hour, 7:30 to 8:30, but after we're past the ORB period. And the third period is the afternoon right before the market closes, 10 to 12:30 p.m. And all of my times are in the Pacific Standard Time Zone. Now from 6:40 to 7:30, I'm focused on the ORB setup. Here again, because we're trying to position ourselves early on in the day for places where we think there might be a strong trend. Second setup that you might find really useful here is the V-shaped reversal. This is especially useful on the index markets, which is where I like to focus on this. My ORB setup, I'm open to all stocks, but this setup, the V-shaped reversal, mostly sticking to the 4 index markets here and maybe some of the commodities or other futures markets we look at. Now from 7:30 to 8:30 a.m., so this is the next hour, I'm focused on trend pullbacks here. I'll show you examples of this, trying to find places where we can either join existing strong trends or find places where we can see price starting to stabilize and use that price stabilization as our means for an entry in whichever direction. I'll show you an example of that as well. And we're employing something similar once the lunchtime hour ends. Notice we're skipping 8:30 to about 10 simply because that lunchtime hour is not one I want to trade. Now let me show you an example of each of these setups. So the first one is the opening range breakout setup. I'm skipping the first 5-minute ORB range, but you could also do that inside of our platform if you wanted. I'm focused on the 15-minute and the 30-minute range, thus my trade time is from 6:45 to about 7:30 a.m. Pacific. Now I chose the top 100 most liquid stocks and I fed them inside of our reporting feature here. I did this on 2 different time periods, the 5-day and the 90-day, and my whole goal here was to try and see where do we see a nice overlap in both sections in terms of ORB performance. A strong performance on the 90-day, strong performance even in the past 5 days in which we've seen this negative gamma exposure environment. Now, on this list of stocks so far, there were 2 that stood out to me. One was EWZ and one was Vale. You can, of course, dig deeper into each of these if you'd like, and this was just off of the 30-minute range. You could repeat this exercise on the 15-minute and the 5-minute range. For all ORB members, you can run unlimited reports. If you're not an ORB member, you can also try manually running this inside of thinkorswim using our free ORB indicator. Now, if you dive deeper into each of these, EWZ and Vale, you can find the specific risk to reward metrics that work for you and focus on just that trade for this upcoming week as the breakout. Or you can also just use our live scanner, in which the scanner will automatically tell you where price is having an ORB setup trigger. You can put in some minimum filters like your minimum win rate, your minimum trade expectancy, your minimum P&L. Keep in mind this will be for the past 90 days, not the past 5 days, but you can of course manually go in and dive into the backtester to see what is the 5-day performance and how did it fare in our negative gamma exposure environment. Your goal here is to try and find a small list of stocks, places where you want to focus on the ORB setup. For example, ones like EWZ, Vale in this particular example. Now, the second setup for this morning period, if you remember, was that V-shaped reversal setup, but just inside of the index markets. Here's an example of that. This is inside of the S&P 500. Whole idea here, again, is we're expecting this negative gamma exposure to lead us to choppy price, increased volatility, especially if we're near 5750 or 5800. Now, I've detailed this setup in previous videos, which I'll link. Here's a quick overview. We're looking for signs of exhaustion here since we're really just fading what the current price is doing. There's 3 signs that I've called out here. One is we'd like to see these Keltner channel wedges. That tells us that price is closing outside of the 3.0, in this case, lower Keltner channel bands. So now we know that, okay, once price has crossed our volatility box zones, we have a volatility edge. Now we're seeing these Keltner channel wedges. That's telling us we're expecting a reversion to the mean using just basic price action and what a lot of algos use to auto trade. Then start to observe more wicks, especially if you start to notice them towards, in this case, the buy side. That's telling you that buyers are starting to step in. Finally, the edge signal confirmation. That's this green arrow right here. That's our overbought, oversold confirmation telling you that now we're expecting buyers to really step in, and you can bring that together with the momentum cross. Now here's where you bring this all together. If you remember, we said buying inexpensive, mispriced options. The out of the money options do quite well, especially when you have spikes like these, which we expect to see in this negative gamma exposure environment. Especially if you're near some of these places where you have that large histogram spike, which we saw earlier on our gamma exposure chart. You want to be wary of that. Now for the afternoon, here's what we're looking for. It's a similar setup, but this time we've opened our universe to all stocks instead of just the index markets. And now we're really trying to leverage the intraday volatility to either join longer term trends or take advantage of places in which we're starting to see the trend exhaust. Now our stock volatility box live scanner will find you everywhere where we're breaching our volatility box zones. That will be a much larger list. So now it's up to you to try and filter it down, and that's where steps 2, 3, and 4 come in. The first step is we'd like to see that we've stopped making new day lows or new day highs. So you'll notice here hiding behind this number 3 is the chart bubble. If you continue to keep seeing that chart bubble form as we keep making lower lows, that's not good yet. Price is still continuing to make lower lows. There's still sellers hanging around, or if we keep ripping to new highs, there's still buyers hanging around. We don't want to see that. Instead, we want to see a lot of overlapping candles, something that looks more like this. You start to see multiple edge signal confirmations. This is on the 5-minute time frame inside of JP Morgan. That's telling you that now for what, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 60 minutes, price has really just traded almost sideways, all near a place where we already expect a reversal, our volatility box models. On top of that, you've seen 1, 2, and 3 over sold confirmation signals. And now you even see our very popular 1-2 punch setup here with momentum reversing. Similar idea to where you can see, again, another pop here, just like we saw inside of S&P, but this time inside of JP Morgan, where those out of the money options, if you have one of these pops, reward you quite well. So that's what I'm looking for in this negative gamma exposure environment. If we come back to where this conversation all began, this is what our negative gamma exposure chart looks like going into Monday and Tuesday. Now, I'd expect that our friends at Bar Chart update this data as we head later on into the week, but for right now, we can use the weekend to prepare for the first 2 days and create a game plan. I hope you found this video helpful. Take care, everyone. If you haven't seen part 1 of our gamma exposure video, I'll leave a link to that in the description box below. Thanks for watching, and I'll see you in our next update.